Good morning. My name is Lance Boat, and I'm going to give a quick 10-minute presentation and summary of the causes of the Great Recession, also known as the 2007/2008 financial crisis in the United States and the world. Just for some back summary, what was the Great Recession? It was a global financial crisis that started in around August of 2007, and it lasted until April 2009. And primarily, was the most damage was done during 2008. It was the worst recession in the United States since World War II. Primarily, also the worst recession around the world since World War II. Many people lost their jobs, with unemployment climbing over 10%. It peaked at about 10.2% in early 2009. The United States' GDP fell by 4.2%, which resulted in significant reduction in productivity and standard of living in the United States. And this was not only felt in the U.S. but around the world as well. Europe had its own sovereign debt crisis that was going on at the time. Africa and Asian countries also saw significant slowdowns that were potentially worse than the United States. Throughout this presentation, if you look at the bottom of each slide, if there are terms that I feel like you might need a little bit more clarity on, I've defined them below. So a recession is a 2-quarter or 6-month period of consecutive decline in macroeconomic activity, usually measured in the United States as GDP, or gross domestic product, which is just the total value of all final goods and services that are produced in the economy, usually measured in a 3-month period of time or an annual period of time. But in order to truly understand what caused the financial crisis and the Great Recession, we need to look further back and see that there was actually a bunch of events and elements that date back to even in the early 1930s that kind of set the stage for this crisis to occur. So the first thing that we have is the Glass-Steagall Act. We also have low interest rates, subprime mortgages and lending, the securitization of mortgages, and inconsistent credit ratings that actually all together really caused this perfect storm of a meltdown globally in our financial markets, and particularly our housing market in the United States. So the first thing that happened was in the midst of the Great Depression, it was believed that loose banking habits and risky behaviors by banks in terms of investments was one of the root causes of the Great Depression and the stock market crash in 1929. So to combat that, in 1933, 2 congressmen, Glass and Steagall, implemented and got passed through Congress a law that basically forced banks to not intermingle with investments. Furthermore, after World War II in 1956, it was also implemented that insurance companies and banks should also be separated. However, in 1999, a new bill formally repealed Glass-Steagall, known as the Graham, Leach, and Bliley Act, and what that allowed for was for these banks to actually go back to the loose and risky behavior that they were undertaking in the late 20s, early 30s that led to the Great Depression. And this kind of sets the stage for the chain reaction of events that occurred after it. Coupled with this repealing and this deregulation that happened in the late 90s, we had low interest rates in the economy. So the Federal Reserve, our central bank in the United States, lowered their target interest rate, which is one of their main policies, as they focus on interest rates and how they interact with the movement and the macroeconomic health of the economy in the United States. Well, they lowered their interest rate from 6.5% down to 1% in terms of their target rate between 2000 and 2003. Well, if the interest rates fall that much, that means that there's going to be a lot of cheap money that's available in the economy. And as a result, what happened is it not only made it cheaper for banks to lend out money, but it also made it cheaper for consumers to borrow. And as a result, coupled with home prices rising in a hot housing market, it really set the stage for banks to try and capitalize on this financial opportunity, particularly in the way of subprime lending. The reason why they went into subprime lending was, well, the market was already moving quickly, so all of their top candidates were already finding homes. So in order to keep kind of the high times rolling and that money to keep coming in, they needed to have more clients and more customers. And so they moved into a lower tier of customer in terms of qualifications, and that's where we get the subprime name from, is that they're below kind of the prime applicant that they would typically accept for a mortgage or a car loan or something of that nature. So, what were subprime mortgages? Well, not only was it just someone that kind of had lower income or someone that kind of had some credit card debt or wasn't perfect in paying their bills on time, it was actually people that didn't even have any jobs at all or didn't have any assets whatsoever. So they're now infamously called ninja loans, but basically there were these fly-by-night institutions and banks themselves who wanted to profit off of these quick closing fees and transactional commissions. And so what they did was they basically approved as many loans as they possibly could, no matter the qualifications of the applicant, so they can make the money. So in order to get the house of your dreams, all you had to do was sign on the dotted line. Now, in exchange for that, you took out, instead of a fixed rate mortgage where you pay a consistent interest rate over the life of your loan, you took out a variable rate mortgage, which meant that your interest rate was contingent upon how interest rates were in the entire economy. Well, currently, at the time when you took your loan out, they were low, so payments were manageable. But as the economy started to turn, those interest rates began to rise. And as a consequence of that, your mortgage payment went up, because instead of paying 3% or 4% interest, you're now paying 12% interest. And when those interest payments balloon, so does your mortgage and your monthly payment on your house. And for people that were already close to the poverty line or did not have consistent income coming in, it was too much. They couldn't keep up with the payments. They saw that their home price was diminishing at the same time, and so it wasn't worth it for them to keep trying to fight this uphill battle, and they would either let their home go or it would be taken back by the bank in a foreclosure. Just to show you how significant this crisis was, that big fat gray column in this graph from the Federal Reserve Economic Database is the length of the recession. So as we can see, starting in around 2006, we see this acceleration of the amount of people that were under foreclosure or were delinquent in their mortgage, meaning that they were behind on their payments. It started at around 2% consistently around 2005, but by the end of the recession, we are still getting increased delinquencies up to upwards of about 11% in 2010. That means 1 in 10 homeowners was losing their homes, or at least significantly behind on their mortgage payments, which is mind-boggling. So, as you can see, a lot of the people that work for these financial institutions had the foresight to know that if we were lending out to people that didn't have good credit, weren't necessarily going to be able to pay these mortgages on time, we want to be able to kind of offload this risk in some way. So what they did was, because of that repealing of Glass-Steagall, they basically packaged up a bunch of the mortgages that they had, and they ultimately sold them off as a financial instrument on the open market. So basically they were playing this very risky game of hot potato. So they would take out, or they would get a mortgage-backed security is what it was called. They would have it in their hands. They would pass it off to someone else. And that way, when all these foreclosures started happening, all these delinquencies started to happen, this asset that had millions or billions worth of mortgages, and that's how the value of that asset was defined, were becoming delinquent, you ultimately had an asset that went from being worth $2 billion to worth absolutely nothing overnight. And that was going to bankrupt you. if you were the unlucky soul that was holding the hot potato when it imploded, when the market imploded. So, not only did they have the foresight to try and get rid of it, but in the event that they got stuck with it, what they ultimately did was they took out insurance on it. So typically the main person that was giving out insurance was known as AIG. So what happened is they would basically issue these credit default swaps, which are basically insurance saying that, okay, if this asset becomes worthless because all these people are delinquent on their mortgage, you will refund me in a form of an insurance payment to cover my loss. So even if you were the unfortunate soul that had that asset, if you ended up passing or taking out insurance on it, you would get a payment, but now the insurance company is the one that goes bankrupt because they can't basically afford to fund all of these claims that are coming in at the same time. And so you basically had the entire financial market at this point, because of this chain reaction of events, imploding on itself. We had banks that had to get bailed out or bought out by bigger companies, and then we also had companies that were let to fail and go bankrupt, like Lehman Brothers. And that really was what set the stage of the financial meltdown in 2008, was when Lehman Brothers went down and AIG went down. You just saw kind of panic ensue in the financial market. But the last thing that kind of helped perpetuate the financial crisis in terms of passing these mortgage-backed securities through, even though they were considered toxic in a way, was that bonds have a rating. There's rating agencies where their main position is to kind of value the risk of an asset and then give it a rating based on that assessment of risk. If it has a high rating like AAA, which is the highest you can possibly have, it means that you will almost definitely get your money back, and usually that commands a lower interest rate. And then the worst is triple C, D, or SD, like Venezuela, where it means that you are in sovereign default, meaning that you're defaulting on your loans. Greece is kind of in a similar position where the bonds that they issue aren't necessarily being paid back. They've defaulted on them, so they're very risky. You might not get your money back. So a lot of the times these assets were toxic, and so really you weren't necessarily going to get your money back. So it would seem and it would make sense that you would rate that bond a low rating, like a B or a C. However, these credit rating agencies were rating them AAA, saying, "Oh, they can't miss. You're definitely going to get your money back. You're going to be fine." And as a result of that, people kept perpetuating this creation of these securities. They passed them through. Banks were holding billions of dollars of these mortgages. People couldn't pay them back. Therefore, they lost their homes. Therefore, those assets became worthless. Therefore, the bank lost a ton of money, and you had this significant drop in economic activity as a result. And that kind of set the stage for the unemployment to rise, for people to lose their homes, people to lose their jobs, and the economic activity to be as damaging as it was between 2007 and 2009. So I hope that kind of gives you a clear roadmap to kind of what caused the financial crisis and the Great Recession. If you have any questions, feel free to ask. And I hope that if you didn't necessarily understand some of the terms, that some of the definitions that I put below kind of help kind of map you and connect you to the story that I was trying to convey. So that's all I have for you right now. So if you have any questions, please feel free to let me know, and thank you for your time.